welcome to episode 65
of Mo Money,
the Investing in Economics show for millennials by a millennial, where our goal is to educate, entertain, and empower a new generation of investors. I am, of course, your host, MC Mo. Let's get to the money. Now, even if you don't follow the stock market on a day-to-day basis, you would have known that recently the stock market crashed. People lost all of their money and the world came to an end. Okay, that's a little over dramatic description. That is not what happened at all. But at the time, for some, I'm sure that's what it felt like. What we experienced was a brief stock market sell-off, but the generally more accepted term would be a correction. Corrections are when the stock market drops 10% from the most recent highs. And although in the past few years, investors may have forgotten that the stock market does anything other than just go up, 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 corrections used to be not uncommon. So are corrections precursors to a crash? Well, they can be, but usually not. So despite what some may have you think, this past correction is no guarantee of a crash to come. Corrections are like earthquakes. Sometimes a small quake is a precursor to the big one to come, and other times it's just a small earthquake. With that said, it does not mean that you should not still be at least ready for when it may come. So this week's episode, we are going to discuss what to do if the stock market crashes. Just a heads up, I am not saying the stock market is going to crash anytime soon. So I hope you are watching this video for one of two reasons. Either one, you really want to be proactive and prepare for when a crash may come, or two, you are 100 years in the future, you somehow found this video and the market has finally crashed. So the first thing to do is the obvious one, but the most difficult. Do not panic. This video is designed for millennials, so it goes without saying that you are young and you have a lot of life left to live, meaning a lot of years left to invest. For a large part of millennials, we were not investing during the last financial crisis, so we don't know what it is like when the market is going down by a lot. But when it comes to investing, it's a lot like quicksand. The more you panic and struggle, the worse that it's going to get. Just a side note, to escape quicksand, you're supposed to sit in the sand like a chair and lift your legs and try to float. So here we are, not panicking, cool, relaxed, head fully attached while everyone else is running around without theirs. Next thing to do is do not sell. This would go hand in hand with not panicking. Your first instinct is going to be to protect the money that you've made and sell everything to prevent yourself from losing money. But emotional investing is dangerous. Selling will have its time and place, but not until you do the next step. The third step of what to do when the market crashes is reflection. This is the time to really look at your portfolio and ask if you took any unnecessary risks over the past months or years. Maybe you bought a bad stock. Maybe you weren't properly diversified. Bull markets can cloud your judgment because the market's going higher every day. You think everything's perfect because you're making money. But as the saying goes, don't confuse genius with a bull market. When the debris has settled, that is the perfect time to reshuffle your portfolio because mistakes are going to be inevitable. And this is the time you will see what needs fixing. This is the time when selling is okay, but not before the reflection. The final and the most important step for when the market crashes is keep investing and keep contributing money to your account. If you can, contribute more than you usually do. When markets crash, there's going to be a lot of great stocks to buy at great prices because in market crashes, everything gets pulled down together, whether it's the cream of the crop or trash. So when a market has crashed, now is the time to start buying. Famous 19th century banker Baron Rothschild once said, "The time to buy is when there's blood in the street." This is how all the big billionaires like Icahn and Buffett got richer in 2008. They knew now was the time to buy. They didn't sit around and lick their wounds feeling bad for themselves for losing billions of dollars probably. Like I said before, we are young and we have many years of investment returns to look forward to. Market crashes are inevitable. Some are big and some are huge. But the market always comes roaring back. That's what the bull on Wall Street represents, the resiliency of the United States economy. So if you want to bet against that and not invest, then just get the fuck out. Bottom line, the stock market could crash the day after this video is uploaded or 100 years from now. All you need to see is this chart, the chart that always comforts me. As you can see, when the stock market crashes, it always comes back and it always goes higher. It's not without a little pain, but for those who are smart enough and can stomach the downturns, they have been rewarded 100% of the time. Those are fantastic odds. Those who panic have received zero rewards. Not to be cliche, but if you weather the storm, there will be brighter days ahead. Much brighter for those who are smart enough to listen. At this point, millennials who are just beginning to invest should be begging for a market crash. The way non-NASCAR fans cheer for crashes when they watch a race, we should be rooting for a crash with that same intensity, because we'll be able to buy stocks that will help us retire and live happily ever after. Thank you so much for watching another episode. You can find new and classic episodes of Mo Money right here on YouTube. For now, don't forget to like, comment, subscribe, share. Follow me on Twitter. Follow me on Instagram. Like me on Facebook. Check out themomoneyshow.com.
Mo Money signing out.